Welcome to Crypto Vocabulary Part 1. We're going over several terms from the world of cryptocurrency. Prepare to learn. Let's do it. The word cryptocurrency. Well, let's break that up. Crypto and currency. You know what currency is, right? That's money. So we then say, what is crypto? Well, crypto is short for cryptography. Now, historically, cryptography has been the study and practice of sending and receiving encrypted messages. Modern cryptography extends encryption into the digital or the computer realm. Cryptocurrency, then, is a digital means of exchange, or digital money. It is secure, as are the transactions conducted with it. The most widely known cryptocurrency is Bitcoin. If you've heard of a cryptocurrency, it's most likely Bitcoin. Bitcoin is a cryptocurrency, but it's not the only one. Other very prominent ones include Ethereum, you probably heard of, and Dogecoin, thanks to Elon Musk. Most people have heard of that one now as well. So the term you may have heard is altcoin. Altcoins are alternative coins to Bitcoin. So essentially, any cryptocurrency that is not Bitcoin is an altcoin. Simple as that. Bitcoin was the first cryptocurrency created in 2009 by a man named Satoshi Nakamoto, not actually his real name. In fact, no one knows who he really is. He was motivated by what he saw in the financial crisis of 2008. He wanted a more secure, more reliable form of currency transactions than those that led to the financial crisis. So he created a cryptographic currency, a digital means of exchange that allows for more secure financial transactions. In many ways, you can think of Bitcoin as simply digital money. If you're curious about what you can buy with Bitcoin, I recommend my video, I Can Buy That with Bitcoin. You'll be surprised at all the different things that you can actually buy with Bitcoin these days. So you've now learned cryptocurrency, Bitcoin, and altcoins. Can you think of some examples of altcoins? We mentioned two of them, Ethereum and Dogecoin. Another type of cryptocurrency is what's called a stablecoin. A stablecoin is simply a coin whose value is pegged to a standard currency, like the US dollar. So one stablecoin will always be worth $1. Let's take a look at these at a favorite site of mine, coinmarketcap.com. This is where all the different cryptocurrencies are listed. The standard view is ranked by market cap. And as you can see, Bitcoin is the largest, and number 2 is Ethereum. Now, to find Dogecoin, we just look a little further down the list, and you can see a variety of different coins in there. And as you'll see as you explore the site, there are literally thousands of cryptocurrencies. Now, as you get involved in the world of trading, you'll hear the term HODL, H-O-D-L, which means to hold on to your coins for the long term. Some hodlers, as they're called, are committed to never selling. The term HODL came from a post in a conversation many years ago where the word hold was misspelled. Now the readers mistakenly interpreted it as an acronym, and it became to know as what many gave the meaning to be hold on for dear life, or HODL, H-O-D-L. Now, hodling is considered one of 3 strategies. The other 2 are swing trading and day trading, both of which come from the world of stock trading. Day trading is, of course, the buying and selling of coins on a daily basis, trying to make the most of small fluctuations in price. Swing trading falls between day trading and hodling. Swing trading is buying and selling on a weekly or monthly basis, still looking to take advantage of price changes, but more based on overall trends. For me, I hodl some coins like Bitcoin and Ethereum, and I swing trade on the rest like Dogecoin. At any time, if you'd like to see one of these terms expanded into its own video, please say so in the comments below, and if there's enough interest, I will go ahead and make that expanded video. Now, if you're going to be swing trading or hodling, you should be aware of DCA, or dollar cost averaging. Now, dollar cost averaging isn't unique to cryptocurrency. It's been used in the stock market for a very long time. The concept is simple. Instead of investing a chunk of money all at once and risk hitting a high point, you even it out over a specified period of time. So instead of saving up $1,000 and then investing that all at once, you would invest $100 out of each paycheck every 2 weeks. The market fluctuates quite a bit, and by dollar cost averaging, you're protecting yourself against putting your whole chunk at a peak or a high point. Some of your bi-weekly investments will be on the higher side, but you'll also catch the low ones with others of your bi-weekly investments, so it will average out. Thus the term dollar cost averaging. Okay? Now there are different strategies within dollar cost averaging. I already mentioned paying some out of each paycheck. If you can only do $10 out of each paycheck, then do the $10. It's still better than trying to save that up and doing it all at one chunk. Some investors like to put their money in on much smaller intervals. For instance, some may put in $10 a day, every day. Others may put their money in every 2 or 3 days. At a minimum, it's recommended to do it at least once a month. But check with your financial advisor, as I am not one. This is not financial advice, merely educational and possibly entertaining purposes. Now, our next term, our next vocabulary is FUD, F-U-D. Put simply, it means fear, uncertainty, and doubt. Many powerful people, organizations, and governments are often accused of generating FUD to drive prices down. To learn more about FUD, see my What is FUD video. The link is in the description below. Some of these powerful influencers are what we call whales. A whale is someone who holds a very large amount of a certain cryptocurrency. A Bitcoin whale is generally defined as someone who owns 100 or more Bitcoin. Some people own thousands of Bitcoin, and there are even some who own thousands and thousands of Bitcoin. Whale watching is one way traders try to predict the market. Now, the last term for today is fiat. Fiat money is the money we all use right now. It's backed only by the good faith and goodwill of the government issuing it. The US dollar used to be backed by gold, but that is no longer true. Hasn't been for 50 years, since 1971, when President Nixon took the US dollar off of the gold standard. As SoFi Learned defines it, a fiat currency is money that is not backed by a physical commodity like gold, but instead backed by the government that issued it. Most modern currencies, such as the US dollar, the euro, pound, and yen, are fiat money. Fiat means an authoritative or arbitrary order. So in the case of fiat money, it's an order by the government that gives them value and makes them legal tender. The current fiat money system came about during the 20th century when countries moved away from the gold standard, where currencies are directly linked to gold. As we said, that's no longer the case, thanks to President Nixon. The cryptocurrency community believes cryptocurrency solves the problems of fiat money. How it does is best saved for a discussion on blockchain technology, which will be in the next crypto vocabulary video. So if you're watching this after August 2021, look for that video to continue your crypto education. If you enjoyed this video, please be sure to hit the like button down below and then subscribe and hit the little bell to be notified when new videos come out. There's also links below, as I said, to some of the other videos referred to in this one. And I encourage you to check those out, enjoy, learn. This is Eyes on Crypto. Keep your eyes on the prize.